For years, investors have been asking this one big question. Do you have to choose between your values and, well, the value of your portfolio? Can a strategy that zeroes in on environmental, social, and governance criteria, ESG, actually deliver strong financial returns? Well, to figure that out, let's put it to the test and dive deep into a real-world example, the S&P 500 ESG Index.
Right. This is the heart of it all. A lot of people just assume that if you screen for ESG factors, you're automatically sacrificing performance. The thinking goes, hey, you're limiting your choices, maybe you're filtering out some really profitable companies that aren't quite perfect. But what if that whole assumption is just wrong? Let's see what the data actually says.
And wow, the data gives us a pretty clear answer. Ever since it launched back in 2019, the S&P 500 ESG Index hasn't just kept up with its famous parent, the regular S&P 500, it's actually pulled ahead. So it didn't just avoid losing money, it literally beat the market.
And if you want to get specific, that outperformance works out to an annualized excess return of 1.62%. Now, I know that might not sound like a mind-blowing number, but in the world of big market indexes, consistently beating the benchmark by over 1.5% year after year, that's actually a huge deal.
But what makes this even more impressive is how it pulled this off. And that brings us to this key idea called tracking error. Just think of it like a leash. It's how far a fund wanders away from its benchmark. A high tracking error means it's taking big, wild, risky bets. But the S&P 500 ESG Index, it did all this with a tiny tracking error of just 1.33%. It stayed on a super short leash, but still managed to win the race.
So that's the big question, right? How did it do it? The first thing you'll hear from skeptics is that it's all just a simple sector game. Let's tackle that argument head on.
This is the classic critique, the go-to argument. The idea is that these ESG funds just loaded up on high-flying tech stocks and dodged the energy sector. And hey, it sounds pretty plausible, doesn't it? But is it actually true?
Okay, so this chart right here breaks it all down for us. It shows exactly where that extra performance came from. That bar on the left, sector weighting, is the boost you get just from being in the right industries. But look at the bar on the right, stock selection. That's the boost from picking specific winners inside those industries, and it's not even close. The takeaway is crystal clear. It wasn't about being in the right sectors, it was about picking the right stocks. In fact, 61%, nearly two-thirds, of the outperformance came from that stock selection effect. So the bottom line is, it mattered less which playground the index was in, and a whole lot more which kids it chose to play with.
And this table just drives that point home. Just look at how closely the ESG index's sector weights follow the regular S&P 500. The biggest difference is a tiny 3.2% extra weight in tech. That is nowhere near enough to explain the outperformance we saw. The whole "it's just a big sector bet" theory, it just doesn't hold water.
So if it's not a sector story, then what is it? Well, the secret is in how the index is actually built. This isn't just someone's gut feeling. It's a very clear, rules-based process for filtering the entire S&P 500 universe.
It all boils down to 5 key steps. First off, it kicks out companies in controversial lines of business. Think thermal coal or tobacco. Second, it drops the companies with the absolute worst ESG scores, the bottom quarter of their industry. Then, for steps 3 and 4, it ranks all the rest by their ESG score and picks from the top down until it captures about 75% of each industry's total market value. And finally, it weights those chosen companies by their size, just like the good old S&P 500.
So what does this all mean in practice? Well, it means about 28% of the S&P 500's total value gets left on the cutting room floor. The biggest chunk gets excluded just because they weren't in that top 75% of their industry. After that, the next biggest reasons are having a really low ESG score or being involved in one of those controversial business activities.
Okay, so we've busted the sector myth, we've seen how the index is put together, now we get to the really fascinating part, the subtle, hidden factors that seem to be driving all this performance. And trust me, the answer is probably not what you'd expect.
It seems so obvious, right? You'd think the secret is just to, load up on the A-plus students, the companies with perfect ESG scores. But the analysis shows that's not actually the winning strategy.
This chart is everything. So, researchers split the S&P 500 into 5 equal groups. They call them quintiles, based on their ESG scores. Quintile 1 had the best scores. Quintile 5 had the worst. Now look at the performance of Quintile 2, the companies with the second highest scores. They consistently crushed the S&P 500. And at the same time, Quintile 5, the companies with the lowest scores, consistently lagged behind.
So the way this index is built creates this really clever two-part punch. It naturally ends up favoring that high-performing second group, and it systematically avoids or kicks out the underperforming bottom group. That 1-2 combo has been a really powerful engine for returns.
But wait, there's another layer to this. Performance isn't just about a static score, a snapshot in time. It's also about momentum. Are these companies getting better, or are they getting worse?
And here's another huge surprise. The biggest boost didn't come from the companies that were improving the fastest. It actually came from the ones with steady, medium momentum. This middle group of improvers just blew the S&P 500 out of the water. And get this, the companies with the highest momentum, they actually underperformed. It suggests that maybe steady, meaningful progress is more valuable than some frantic, maybe even unsustainable sprint to the top.
All right, let's dig into one final and maybe the most overlooked piece of this entire puzzle. We talk all the time about the E for environment and the G for governance, but what about the S for social? You can see the index has real benefits across all three areas, but let's zoom in specifically on those social metrics for a second. More exposure to companies with strong corporate citizenship and better systems for rewarding their employees. Now, these might sound like soft ideas, but the data is telling us they are incredibly important financially.
This chart just lays it bare. When you look at all the stocks that beat the S&P 500 in the years they studied, a huge chunk of them, way more than you'd expect, were companies that also got high scores on these key social factors. There seems to be this persistent, powerful link between strong social practices and strong stock performance.
So what are we actually talking about when we say social? This isn't just fluff. It comes down to really concrete business factors. Things like human capital development, how well a company actually invests in its own people, and talent attraction and retention, its ability to get and keep the best employees. I mean, in today's economy, a company's people are often its greatest asset, and these metrics show you who's managing that asset well.
Okay, let's pull all these threads together. We started with a pretty simple question, and wow, we found a complex and really fascinating answer. It wasn't about big sector bets. It was all about a systematic, rules-based way of selecting stocks.
And that brings us to a final thought. All this evidence suggests that this ESG method isn't just screening for goodness. It seems to be screening for real markers of high-quality, resilient companies. Things like great people management and a focus on steady improvement. And if that's the case, maybe the whole debate is framed wrong. Maybe it's not values versus value at all. Maybe certain values are actually some of the most powerful indicators of long-term value you can find.